Hey, good afternoon, ladies and gentlemen. Welcome back to the 10th of February weekly market review. As usual, I have with me Mr. Gerald Wong today. How are you, Mr. Gerald Wong?
Hi, good afternoon, everyone. Very well. I think we have seen very strong performance by DBS as well as the Straits Times Index today. So for those who are holding on to DBS shares, for those of you who have STI ETF, I hope to be able to share what is driving some of this improvement for the market sentiment through today's market review.
Yes, indeed. So it's just fresh out of the oven.
Mm.
DBS record profits and records all-time high again. DBS share price broke the $46 level this morning, carrying the STI index to a new all-time high. Let me just double check that all-time high figure is at 3,921 points this morning, rewriting the records in 2007. Okay, so over the weekend also we heard Donald Trump saying some tariff threat again. So this is a second consecutive weekend, second consecutive Friday in a row. He has threatened to lever tariffs on his allies, countries, and some of the other nations, which he views that is unfairly treating US. So this is going to be a continued kind of occurrence, I believe, and that will lead to more volatility. So Singapore itself as a safe haven could benefit from this, and also the three banks carrying our index would also be able to capitalize on the high interest rate environments. Even the REITs, given the volatility in the markets right now, the global markets could also have a place to stabilize amidst this global uncertainty. So I'll let Gerald carry on with today's session. He will talk about some of the indices broadly, and then he will talk about SGX and some of the REITs earnings as well. Over to you, Gerald.
Thank you, Sunny. Okay, before we start the usual disclaimers that today's sharing is for information purposes only and should not be taken to be financial advice. Okay, we have a Ask SIAS this Wednesday, 12th of February. So if you've got any questions for Sunny and myself, you can register by scanning this QR code, and I hope to see you at this Wednesday's session. If you find our weekly market review helpful, do leave us a review on Google. And if you're wondering how you can join SIAS as a member, you can go to this QR code or this website, sias.org.sg/membership. And as a SIAS member, you can access various online resources as well as investor education programs. Okay, so what did we see in the market last week? We saw broad declines in the US markets. The S&P 500 was down by 0.2%, and the Nasdaq was down by 0.5%. Okay, this was largely driven by the tariffs that were announced by Donald Trump that led to a lot of uncertainty in the market. Closer to home, we saw the STI actually outperforming with a slight 0.1% gain. Like Sunny mentioned, the Singapore market was seen as a safe haven amidst all of this uncertainty. And we have also got a few names that reported positive results, and that helped to lift the index to 3,861 points. Okay, so in broad summary, what happened was that over the previous weekend, Donald Trump announced a 25% tariff on imports from Mexico and Canada and 10% on Chinese imports, and those were set to take effect on 1st of February. However, on Monday, Trump further announced that he has agreed to delay tariffs on Mexico and Canada for 30 days, and that actually meant that they were negotiating some of these tariffs. So why did this announcement of the tariff actually led to investor concerns? It was really because the tariffs were seen as being inflationary, and if inflation were to pick up, that would potentially slow down the pace of US Fed rate cuts. At the same time, if we have got some disruption to global trade, that will drive fears of weaker global growth. And at the same time, the US dollar will continue to strengthen, and that will put further pressure on emerging markets. Okay, so I think that is the reason why we saw weakness in some indices initially when the tariffs were announced. So if you're wondering how the tariffs could potentially impact inflation, there were some reports that were put out in that if really this tariffs were to come through, 25% tariff on Mexico, 25% tariff on Canada, then that will actually increase the US Consumer Price Index by about 12 to 13 basis points. Okay. In addition, if there's this 10% additional tariff on China coming through, then that will bring the CPI up by another 11 basis points. So I think that is really the key concern, whereby if this tariffs were to be implemented, then what we have is an increase in inflation in the US. Okay, the other impact that we see is really the strength of the US dollar with the tariffs that are going to be announced or have been announced. We have seen the US dollar hitting the highest level since November 2022. And that is once again because of the concerns around inflation. And if that happens, the US Fed may not be able to cut interest rates as quickly as what the market now anticipates. Okay, closer to home, we actually saw the STI having a slight gain. We saw a few names with very strong performance in the past week. SGX is one of the star performers with a 14% gain, bringing it to the highest level since 2007. At the same time, we also saw strong performance by ST Engineering because of the strong orders that were announced that led to a 3.3% gain, and CapitaLand Ascendas REIT with a 1.9% gain after they reported their latest earnings. On the other hand, we have got some of the names that are linked to the Jardine Group. Jardine Matheson down by 3.7%, Jardine Cycle and Carriage down by 3%. So those actually make up the STI worst performers in the past week. Okay, we've got quite a number of names that reported earnings last week. I'll start with CapitaLand Integrated Commercial Trust. We saw the share price coming down since September last year from about $2.15 per share to about $1.90, and it has stabilized around the $1.90 to $2 level. So what we saw for CICT is that in the second half of 2024, distribution per unit of 5.45 cents, and that is unchanged from the second half of 2023. Okay, with the first half distribution per unit of 5.43 cents, that will bring the total distributions in FY 2024 to 10.88 cents. Okay, overall, we saw fairly stable revenue as well as net property income by CICT. The gross revenue was up by 1.7% for the whole of 2024. Net property income was up by 3.4%. If we were to look at the performance across the various assets, retail actually did better. We saw an increase in the revenue as well as net property income of the retail assets. Office weakened slightly compared to the previous year, and combined together, we saw this slight increase in the revenue as well as net property income of CICT. Okay, so this is a further snapshot of the stats across the retail as well as office assets. Overall, in terms of the portfolio occupancy, it was up by 0.3% compared to the previous quarter. Once again, retail was what actually performed very well with an occupancy rate of 99.3%, and that represents a 0.3 percentage points increase compared to the previous quarter. Okay, office was at 94.8% occupancy, which was also up compared to the previous quarter, but definitely the occupancy isn't as high as what we see for retail. Overall, in terms of the tenant sales and shopper traffic, we saw growth in the whole of 2024. And once again, that helped to support the rents that CICT was able to get for its assets. So we see here the rental reversions for the retail portfolio was at positive 8.8%, and for the office portfolio, it was at 11.1%. In terms of the balance sheet of CICT, once again, very healthy at 38.5% at the end of December 2024, compared to 39.4% as at 30th September 2024. What CICT has also shared would be some of the asset enhancement initiatives, including for IMM building, for those of you who stay in the West. So we saw phase 1 and 2 of the AEI completed in the fourth quarter of last year, and the tenants have started operations, and the phase 3 of the AEI will commence and be completed in the third quarter of 2025. Okay, so if I was to look at the valuation of CICT at this point in time, price to book ratio of about 0.93 times, which is above the historical average. Dividend yield of 5.6%, which is above the historical average. So for investors who are looking for REITs with stable distributions, and if this 5.6% looks attractive enough for you, then maybe CICT is worth a look. Okay, next we have CapitaLand Ascendas REIT, another REIT which actually saw a bit of a bounce after the full year results. Okay, so what we saw for CapitaLand Ascendas REIT is that while the gross revenue came down by about 1.1%, this was due to some of the divestments that actually happened in the previous quarters. The net property income actually increased by 1.4%, as it was able to bring down its operating expense. So with that, the distributable income actually increased by 3.4%, and the GPU increased by 3.2% to 7.681 cents. Okay, if you were to look at the occupancy across the various assets for CapitaLand Ascendas REIT, overall the portfolio occupancy increased to 92.8% from 92.1% in the previous quarter. Okay, Singapore saw a slight improvement in terms of the occupancy, likewise in the US and Australia. Okay, so overall, we saw improvement in occupancy across the key geographies, and that helped to lift the overall occupancy of CapitaLand Ascendas REIT. In terms of the rental reversions, we saw fairly strong rental reversions across the portfolio as well. Singapore 7.2% in the fourth quarter, US 11.6%, Australia 6.6%. So overall, that led to positive rental reversions of 8.6% in the fourth quarter of last year. Overall, going into 2025, they expect the rental reversions to be in the positive mid-single digit range. So we'll continue to see positive rental reversions into this year. For CapitaLand Ascendas REIT, once again, strong balance sheet, leverage of 37.7%. So a stable REIT in terms of the distributions, as well as a balance sheet that will make most unit holders be able to be comfortable with, given that it is below 40%. Okay, at the same time, CapitaLand Ascendas REIT has also announced various asset enhancement initiatives as well as divestments through 2024. So through this active capital management, it has been able to grow its distributions. In terms of valuation, CapitaLand Ascendas REIT now at 1.16 times price to book, which is above the historical average in terms of the price to book ratio. And the dividend yield of 5.8% is close to its historical average. Okay, last one name that many investors were wondering why the share price went up so much in the past week. SGX reaching close to $14 per share, which is the highest level since 2007. So SGX reported the earnings for the fiscal year first half, which is the 6 months ending December 2024. And we saw improvement in terms of its profit. So the revenue grew by 15.6% compared to the previous year, and the net profit grew by 20% compared to the previous year. So that represents a very strong growth in profit for SGX. What we see is broad-based growth across all revenue segments. We saw the derivatives growing significantly, the FX also having growth, but importantly for the cash equities division, we saw an increase in terms of the securities daily average volume. So that also helped to improve the revenue for the cash equities business. So with the increase in net profit, SGX has also announced an increase in the dividend per share, quarterly dividend of 9 cents, and that will bring the total dividends in the first half of the fiscal year to 18 cents, an increase from the 17 cents in the previous year. Okay, the other thing that many investors are looking forward to would be this MAS review group to strengthen the Singapore equities market. That was announced in August last year, and when it was announced, they had shared that this would probably take about a year. So given that we are now in February 2025, and the outcome of the review group is expected to be announced by August 2025, I think investors are increasingly looking forward to what can potentially come out of this review group to improve the Singapore equities market. So if I were to look at the valuation of SGX now, PE ratio of 24 times, which is above the historical average, dividend yield of about 2.6%. So in terms of the valuation, it is above the historical average, but many investors are looking forward to what may come out of the review group and whether that may help to further improve sentiment towards SGX. Okay, going into this week, we just saw DBS announcing the results this morning. They also announced a dividend hike as well as further reinsurance on the dividends going to 2025. On top of that, we have got the US Consumer Price Index data this Wednesday, the 12th of Feb. And for those of you who are looking at the T-bill, we have a T-bill auction this Thursday, 13th of Feb as well. Okay, so a fairly packed calendar. And with that, I'll hand over to Sunny, who will share with us the technical analysis.
Okay, thank you, Gerald, for that detailed update on some of the earnings results on the Singapore market that came out recently. So, as Gerald mentioned, this morning was DBS results. So, yes, we confirmed a 60 cents per share dividend, quarterly dividend confirmed. And I think this is going to push DBS price higher now. I'm looking at the DBS share price now around the $46.11 level. We could be on the way to the $50 level in the mid to long term. Okay, so record profits, record earnings from DBS pushing the STI higher. Hence, I would start with the STI index, which was also helped by SGX earnings, which Gerald shared earlier, and the MAS sort of review group is expected to give the Singapore Stock Exchange probably increased liquidity, increased volume. Hence, investors might have also front run some of those news or expectations, but the results came out to be fantastic because SGX exchange has been a very good venue for managing the risk because of its liquidity. So with the global uncertainty right now, SGX is actually riding on this wave of global uncertainty, and Singapore being a sort of a investors look to Singapore market as a very stable and sort of yield enhancing or looking for yield investment. SGX will be a good venue to look at given that some of our stocks have very high dividends, including the banks and the REITs, which Gerald went through earlier. So as long as the REITs continue to increase rental reversion, maintain or increase their DPU, I think this could be also a bright spot for the REITs because of the big fluctuation of volatility in the global markets. For investors who want to seek stability, they could be looking at the Singapore markets and some of the REITs as well. Okay, on the STI index, we hit a all-time high this morning at 3,921 points. Okay, that was early part of morning. We sort of pulled back to now 3,891 points. So there is it is now at the all-time high. We don't have a next resistance level, so-called, okay, for the STI index to have a reference, but definitely being like about 80 points away from the 4,000 psychological handle. okay, or what we call a round number handle, that could actually be one of the year-end targets that we are looking at. Okay, the next resistance level could be around the 3950 or 4000 level. But looking at the support level on the STI, if you want to get into the broad-based STI index, 30 stocks STI index, you will look at the support level of the 20 days moving average first, which in the past 1 month in January, you can see over the period over here, has been holding up very firmly on the 20 days moving average, and that is around the 3,813 or 3,822 points level. So this will be the first support level for the STI index, followed by the 50 days exponential moving average, which is the blue line at 3,785 points. Lower bound of the Bollinger Band is at 3,757. So definitely if it hits to the blue line or the lower bound of Bollinger Band, that is definitely a sign of accumulation. But looking at the momentum wise, looking at the technical indicators, we can see that MACD is showing a positive reading. So that means it's firmly still in an uptrend. And there seems to be some divergence of the MAC line away from the signal line. So that could mean that in the mid to long term STI, at least for this year, could be looking at a continuation of the uptrend that we see very prominently and strongly during the second half of 2024. So STI is still looking good for the first half as well as for the longer term towards the end of the year as well. But on the RSI, we have a 65-point reading. It's still a very healthy and very strong reading. Okay, just 5 points away from the 70-point sort of a overbought mark. And when it hits that level, then we will expect some kind of technical pullback. But as of now, let's see if STI is going to hit that level, if it's going to have a all-time high closing as well. So the previous time the RSI hit the 80-point level, which is in the December period, 5th December, you can see we saw a technical pullback. It does not break the uptrend channel, and hence it has a rebound back upwards. Okay, so similarly in November as well, after it hit a November high on 11 November, we still go into a consolidation mode, supported by either the 20 days moving average or the 50 days moving average. So these are the two key moving average that you should be looking out for if you want to accumulate into the broad-based STI index, 30 stocks index. Okay, so STI is looking good, so that's a good sign. And of course, on the US indices, Gerald shared earlier the weekly performance of the US index, which is down around 0.5% for the whole trading week last week, and it was mainly put down on last Friday, towards the second half of Friday trading, I would say as well, because Donald Trump mentioned during his visiting friend from Japanese Prime Minister that he is going to announce reciprocal tariffs for some of the nations. Now, this is a statement that could reignite a global trade war again. So the previous Friday, we saw that he mentioned Mexico and Canada 25% tariff and China 10% tariffs. So this time around, more countries will be involved, and he has also mentioned that he's going to lever a 25% tariffs on US steels imports. So major exporter of steels to US include Brazil. So that could also impact a lot of other nations. So further looking into that narrative, we could also expect some kind of retaliation efforts from the other countries as well. So market is going to be very volatile, especially on the global and the US side, until this tariff war play out. Okay, so on the Dow Jones Index, okay, we dropped about 1% last Friday. So giving up most of the gain that we saw, we actually had a sort of a two consecutive winning streak of winning trading days on last week. And that pushed the index slightly higher, but we gave back most of that gains on Friday. Okay, so the Dow Jones Index, the all-time high remains at the December high, which is at the 45,073 points level. We are unable to test that level right now. We are seeing a pullback. So where does the pullback go? I think likely the support will come in at the 50 days moving average, which is the blue line that you see here, now reading at 43,712 points. And this level is sort of a mimicking what we saw in November last year. It challenged the blue line, and then we have a good rebound. Okay, so this is the first level of support that I'm looking at, 43,712 points, with the lower bound, the amber line here, the 100 days exponential moving average at 43,041 points. This is the support that I'm looking at for the Dow Jones Index, which was tested in the early January and late December period. On the indicator wise, the momentum on the Dow Jones Index, which always has a very good performance in January because it's what we call the January effects, and also the big US banks reporting their earnings during this period, which usually carries the Dow Jones Index higher. We are seeing that the rally in January is now subsiding in momentum already. And the MACD is now closing in on the signal line, which if a crossover happen will lead to a negative MACD reading, and that could mean that we may be on a downtrend again. Okay, if a crossover happen and we see a negative MACD reading. The RSI has also pulled back already from a last week high of around the 68 point level, 2 points shy of the 70 point mark. And now we are at the reading of 54, which means that's very weak momentum. We are close to the neutral line of 50. So remember in the November period, as you can see over here, once it hits the get close to the 70 point level or hit the 70 point level, we will see a retracement on the Dow Jones Index, and it would likely go back down to definitely below the 50 point neutral mark, closer to the 30 point oversold level before we start to see a rebound on the Dow Jones Index again. Okay. Next, let's move to the broader index of S&P 500. Last Friday dropped 0.95%, close to 1% as well. What is to note is that I observed during last week trading session, Monday was of course down because it was a carried over from the threats that Donald Trump stated the previous Friday. And then of course market gap down on Monday itself. But then in the next three trading session, Tuesday, Wednesday, and Thursday, it actually managed to score a three consecutive trading winning session. So that's sort of a negate or the impacts of most of the threats that Donald Trump has delivered so far in the previous Friday. But of course, he started those threats against on last Friday itself. So you can see this pattern is going to continue to follow through. And if you look at the US futures this morning, it is starting to push back up again. So I think we are likely going to go into a consolidation mode on the broad S&P 500 index, which will likely trend around the level of the high at 6,128 points, which is the high that we saw on 24th January, with the support level around the 50 point exponential moving average at 5,979 points. So I would believe anything below the 6,000 level could be a good accumulation level on the S&P 500 index, with the next support level at the 100 days moving average at 5,881 points. Indicator wise, it is not really looking any better than the Dow Jones Index. We see a bit of a bright spot that the MACD line tried to sort of diverge upwards away from the signal line because of some of the positive earnings that we see so far in the earnings season in US. But then Donald Trump has always been capping those gains. Okay, so I do not expect any big movement. According to the MACD indicator, it's also close to crossing the signal line. Hence, if we get a negative MACD reading, that could mean that we can pull back further below the 50 days moving average towards the 100 days moving average. Okay, the RSI at 51 point is a very neutral reading, stating that there's not much of a momentum. Any upside from the earnings results of US big companies are negated by the comments made by Trump. So market is not showing any kind of a strong or indicative momentum that we can ride on. So range bound for the S&P 500 on the top side, 6,128 points. On the lower side, it could be around the 50 days moving average at 5,979 points. Okay, 5,980 points. I'll round that off. Lastly, towards the most volatile tech heavy index, which is the Nasdaq Composite. So we also managed to score a 3 session in a row winning streak on the Nasdaq Composite, but then we given up most of those gains on Friday on Donald Trump's threat, which was the Nasdaq suffered the heaviest loss compared to among the 3 US indices. So it is resting very close to the 50 days moving average right now at 19,461 points. Last Friday closing was 19,523 points. We already had a negative reading on the MACD indicator, indicating that the downtrend would likely continue. And if you look at the broader picture, the whole of January, after we hit the high in December, we have not been able to get close or retest that level. And hence, if let's say I was going to draw a trend line somewhere here, you could be seeing that pressure could be coming in whenever the index starts to wants to sort of reach out above this trend, it would get hit back down again. Okay, and on the support side, the 100 days moving average 19,022 points, or the 19,000 handle, continues to be a good support level for the Nasdaq Composite Index. Reason being, we need to give some sort of a buffer or margin of safety, given that it is the most volatile and could be greatly impacted by some of Trump policy. So the RSI has also gone below the 50-point neutral mark. So that means it has quite a bit of a negative momentum right now, not even neutral. It is slightly negative. So we expect the confirmation of the MACD and the RSI, that the Nasdaq Composite will likely head down, and hence I'm looking at accumulating the Nasdaq Composite Index further towards the 19,000 handle, rather than what we see right now, which could be at the pivot point of 19,500 points level. Okay, so these are my updates on the index this week. A volatile week, a volatile outlook that we have on the global markets, but Singapore is a bright spot for safety. So anything else to add, Gerald?
Yes, I think now that STI has reached a new all-time high, we'll be looking to see what further happens from here on that can potentially help to drive the STI higher. We have the US CPI data that's up this week, and then we've got more of the banks reporting from next week onwards. So I think those are the key data points that I'll be keeping a lookout for to understand how the markets will move from here.
Yes, and hopefully those Singapore banks that we see earnings coming up could push STI to a further all-time high in February, and we will keep all of you updated here on the next weekly market review. Okay, so everyone have a safe trading week, trade safe and stay safe, and we will see you on next Monday, same time, same place. Goodbye.
Thank you.